Hello, everyone, and welcome to another episode of the A&H Berts Stockpickers Podcast with Albert and Hubert.
Here, each week, you can join us in discussing our favourite stocks where we can help you find your next investment opportunity.
We aim to present and discuss the investment thesis for our top picks.
Let's get right into this week's choice. Today, I will be taking the hot seat and I'll be pitching Barclays PLC. Barclays is a multinational bank with operations in many different types of banking, including retail banking, commercial banking, private banking, and investment banking. Has a current market capitalization of just over 34 billion and manages 1.349 trillion worth of assets. It has a primary listing on the London Stock Exchange and is a constituent member of the FTSE 100 index, and it's also listed on the New York Stock Exchange. The first reason I'm pitching Barclays is because of the strong company performance recently. The Q3 report showed profits jumping to 2 billion in the July to September period. This is nearly double its Q3 earnings last year, which were 1.1 billion. And this year's earnings smashed the earnings forecast, which was around 1.6 billion. One driver of the company's strong performance is from its retail side, credit repayments. So that includes credit cards and mortgages. This is driven by excess savings of around 15 to 20% as a percentage of the 2019 consumption in the UK. And this figure is around 20% in the US. Another area of strength was its advisory and equities area. The return on equities was at 16.4% compared to just 10.5% a year ago. The investment banking income has also risen significantly at 971 million, which was at 610 million in Q3 last year. This particular growth was driven by a surge in the US mergers and acquisition fees. Barclays is unique among British banks in competing directly with US banks in the investment banking sector. As consumer confidence has gone up, more debt is being taken out, which will further drive growth in their credit area.
So I'm going to just sort of chip in there briefly and maybe ask you a few questions on that and sort of add a few little points. First of all, if we're looking at sort of, there are two main things I think we're looking at when it comes to credit for something like Barclays. We're looking at the level of repayment of old debt, which is necessary to keep up, their assets and their balance sheet. And then, we want people, then one of the main drivers of growth, obviously, is people taking out more loans. So we have both sides strong, but obviously we also have the primary side. And what do you think about this sort of the atmosphere and the environment for IPOs moving forward into the next couple of years or so? It's my personal opinion that I think due to a strong and potentially a strong recovery that could kick in, there could be a great appetite for far more IPOs or primary side deals, which would also give a massive boost to the primary side earnings for Barclays. Is this something that you've done in your analysis? Do you think this is something we could focus on?
I mean, certainly, I think that there is definitely the potential for a surge in the number of IPOs. And if that is indeed the case, then Barclays will certainly benefit from the primary side IPOs. Of course, the other various its competitors will also benefit too. So I don't know if this will necessarily set Barclays apart from the rest of the banking sector.
Yeah, that's understandable. Yeah.
My second reason for pitching Barclays today are the dividends and the possibility of an increase in the share buyback. Currently, the buyback program is just under 4% of market cap, which when you combine with dividend yields, you get a fairly modest return. The dividend yield is currently standing at 1.58%. However, with increased earnings, as I've just explained, very strong Q3, we expect that Barclays will seek to return capital to investors through share buyback programs and through increasing the dividend yields. This, I believe, will provide a lot more value for the position. There's also the expectation of yields rising, and we see a strong positive correlation between yield levels and the stock returns of financial sector companies.
So if we take that analysis and we look at the sort of Bloomberg data, we can see that one of the highest drivers of growth and performance for Barclays and the Barclays share is actually the share buyback scheme. if we look at the 1-year share buyback, we're looking at a 2.9%, which in comparison to its peers at a median of 2.8%, this is actually quite strong. And if we look at the entire sector of shares on the whole, we're looking at a very, very strong position. Most companies are not engaging in share buybacks. So this will give a very high payout ratio if these buybacks do come to fruition, as we expect.
Yeah, I mean, of course, there's an if there, which is if they do come to fruition. And I think there's every reason to think that there will be. I know that so far there hasn't been a confirmation yet of an increase in this program. But I think that, given the huge amount of capital that they now have, it would be far more likely that they do end up increasing their share buybacks and their dividends. That seems to make the most sense at this point.
Yeah, especially given their incredible cash holdings right now. It just their level of cash and cash equivalents is exceptional now. It's the highest it's been since 2014. We're looking at about 346 billion.
Yeah, a lot of this was set aside for bad loan provision. However, a lot of what they anticipated would happen in terms of defaults just never ended up happening. So as a result, they now have a lot of cash that was bad debt provision, but they now no longer need to hold. And so I think that there's a good chance a lot of that will be returned to shareholders.
Yes, and that also puts them in an incredibly strong position in terms of their balance sheets. It gives them a very, very good position to be in and a very, very low risk of defaulting on their own loans.
Oh yeah, for sure. I mean, they've got they're in a very, very secure position right now with all of these provisions. So yeah, I think that they're in a very safe position, and there's far lower risks here. So my final point is that this stock represents very, very good value. Overall, the banking sector is generally considered a good value, and companies generally trade affordably. However, even within this undervalued sector, Barclays, I believe, stands out as being undervalued and even better value than many of its competitors. Firstly, it has a low PE ratio of 7.93. Now, this is significantly lower than a number of its competitors. So, for example, UBS is currently at 10.92, BNP Paribas is at 12.95, HSBC 18.96, and Lloyd's at 40.84. Another reason is that it operates with very low levels of debt in its capital structure, meaning that it is a very safe hold. Another reason is also that there is a strong consensus that Barclays to either buy or it will outperform. It has a median share price target for 12 months at 235, which represents a 17.78% increase from its current price of 199.52. Finally, all banking stocks are strongly correlated with 10-year US and UK yields. Right now, we are at an all-time low. However, it cannot stay this low forever. And at some point next year, these rates will almost certainly rise. The refusal to raise them just yet, as the Federal Reserve and the Bank of England recently stated, does present for potential buyers of Barclays a good opportunity to buy now before they announce an increase in the rates. So because of these, I think that Barclays, even within the banking sector, represents very good value.
Yes, and on that note, we can see some key drivers of the value sector, if you may, outperforming growth in the next couple of years or so, which is really strong. So first of all, like key things we've seen in the past for value outperforming growth, of course, we've mentioned the yields. As yields rise, we tend to see value outperforming, and we've already discussed this. But furthermore, a key point is global integrated and consolidated growth tends to value instead of growth. So with an expectation for a synchronized global growth coming in over the next few years, as all countries start to recover from COVID simultaneously, maybe at different rates, but they're all starting to recover, we can expect the entire value sector to outperform, which, for most people, value would probably be defined as the banking sector and the utility sector. So it's really positive. And, given Barclays' position as, having an even better value than its competitors, not only can we see value performing well, but we could even see a re-rating kicking in for Barclays as well. So further points on the value note there.
Yeah, definitely. And I mean, if you're right, if this prediction's right and value will outperform growth, then I think that Barclays looks poised to certainly be the beneficiary of that. So in that scenario, this is a company that definitely will benefit.
Wonderful. And just to sort of wrap up, I do have a few questions to ask about the stock itself and about the company. So first of all, it's actually around its CEO. So recently we had a lot of problems with the CEO given Epstein links, but he has now left the business and has been replaced by, I believe, one of the sort of the head risk managers who used to work at JP Morgan. Now, what do we see going forward in terms of this change in management? Is this going to be a positive? Is this going to be a negative? Because there's certainly a lot of uncertainty around this right now.
Yeah, of course. I mean, it was fairly unexpected, the sudden CEO change. So the new CEO, CS Venkatakrishnan, has pledged that he will retain Barclays' current strategy of competing with Wall Street firms in the M&A area and in other investment banking areas. So it looks like, at least for now, there won't be any major changes in strategy with the new CEO. There have been some concerns that the new CEO hasn't had experience running a large organization before. However, I think that this isn't a major issue so far. He obviously has very, very good experience. He worked for 22 years at JP Morgan before leading the Model Risk Group in 2012, and was then later brought into Barclays as its chief risk officer, and last year became the global head of markets. So it's clear that his experience is definitely still very, very good, even if he hasn't necessarily led an organization the size of Barclays before.
Wonderful. So I guess we can expect a decent level of confidence in this new CEO, which is very positive. So my second question is around an ESG point, and obviously ESG is very poignant in the banking sector right now when it comes to investors. Barclays put aside about 5.6 billion very recently and put it into fossil fuel companies. How does this what does this entail for Barclays in terms of its view, in terms of ESG investors? Will this become a negative? Will this negatively impact the stock, or will it not be that significant?
Yeah, so I think that that Barclays currently, its ESG credentials are not necessarily exceptional. For now, yes, they do still have significant involvements in fossil fuels. I think there's a strong possibility that in the long term, they will look to winding down this area of their business in order to improve investor relations and ensure that they can be the beneficiaries of the significant increase in ESG investing in recent years. It's possible that, yes, in the short term, they could lose out to competitors who are more ESG driven. However, long term, I think that they will certainly adapt to this.
Yeah, and I mean, if we look at the sector as a whole, a lot of these banking companies, a lot of these banks do still have a very decent involvement in the fossil fuels industry, and I think as a sector it's starting to wind down now. So there is an expectation that Barclays will start to wind it down as well.
Yeah, certainly. I think that's very likely, as their competitors are either already doing or have pledged to do the same, and it seems very likely that Barclays will follow suit to boost its ESG credentials. Another challenge in the short term potentially for Barclays is a low interest rate environment, which at least for now appears to be set to stay. So the Bank of England announced that their 0.1% base rate isn't going to be raised. And this, of course, gets passed on to institutional lenders. It reduces the possibility of their loans with a lower interest margin. This has hit Barclays in the Q3 earnings. Its FICC division, which includes fixed income, currencies, and commodities, has seen its profits fall from 1 billion in third quarter 2020 to just over 800 million in 2021. And the bank claims that the reason for this is due to the globally low interest rate environment, which reduces the spreads on fixed income, which in turn has reduced clients' demand for these products. So unfortunately, for the short term, it looks like this will be here to stay. So for now, this could continue to put pressure on Barclays' fixed income, currencies and commodities division and squeeze profits in that area.
Yeah, I mean, that is a very fair point. But like we discussed, if these interest rates can't stay this low forever, it'll be a very unsustainable position for both the UK and the US to maintain. So I guess this, if anything, just provides a buying opportunity now before things start to really kick in, within the next couple of years or so.
Yeah, for sure. I don't think that long term this will pose a serious problem for Barclays. Yeah, the current rates are unsustainable. They will be put up again, and then at that point, this division should see its earnings recover, and in turn, client demand will likely increase. So yeah, I think that for now, it's something to keep in mind. But yeah, going forward, I don't think it poses a serious risk for Barclays.
Before we wrap up, again, quickly answer one of the questions we got from one of our viewers last week. So their question was, do we think Wizz Air has the potential to overtake Ryanair completely? Now, to answer this question, what we discussed last week was we were looking at the levels of growth rates. We think that Wizz Air is far better positioned for growth. Now, we're not necessarily saying that Wizz Air will overtake Ryanair, and capture its entire market. We think this is unlikely given Ryanair's quite strong incumbent position in the Western markets. We just feel that in terms of an investment opportunity, Wizz Air provides a better potential for share price growth, given its greater scope for growth, given its position in the Eastern European market.
Well, we hope that you enjoyed this week's discussion.
Let us know your thoughts on this week's pick in the comments and on our social media, and send any questions you'd like answered in the next episode.
If you have any suggestions of stock you think we should cover, please let us know.
And see you next week for another episode. Thank you.